So we're absolutely delighted to have Chris Mittleman here with us today. He serves as the Chief Investment Officer for Mittleman Investment Management and directs investment policy, research, and portfolio management for the firm. He has provided investment strategy and portfolio management for more than 30 years to clients, including high net worth individuals, corporate pension plans, foundations and endowments, and other institutional investors. He managed private client portfolios for Spencer Clark as Senior Vice President of Investments from 2002 until 2005, when he co-founded Mittleman Investment Management with his brother Phil Mittleman. Prior to that, he was an investment executive at UBS for 12 years. He began his career in 1990 at Shearson Lehman Hutton. Thank you for joining us today, Mr. Mittleman.
Thank you for having me.
Terrific. So maybe you can just get started with you describing a little bit your investment philosophy.
Sure. Our firm is a value-oriented investment firm, and I'm sure you're familiar with the concept. I've watched many of your interviews. You certainly understand the discipline, and that's one of the reasons that attracted me to this opportunity to speak with you. So I consider myself one of the old school value type investors, really with a focus on valuation, which seems to be increasingly rare amongst the peer group. It seems that in a world that's gotten more and more expensive, there's been a lot more kind of bending on valuation, I think, than there used to be, and that's fine. It doesn't mean it's wrong. It's just different from the way that we've practiced it, and so I do think that valuation is very important for us, and we do try to focus on situations where we think we're getting a fairly extreme discount to our concept of intrinsic value. And so I grew up learning about value investing in this business by just reading about what others had done. When I started out at Shearson, I just picked up all the different books of the time, John Train, The Money Masters. I read the Buffett letters, which was very impactful, very eye-opening. As Buffett says, it either takes or it doesn't take, and it kind of took with me right away. I basically just read everything I could read and found out that value investing seemed to be the most, the kind of safest way to go about trying to invest in an uncertain, world, in uncertain markets. It seemed that having that margin of safety just kind of conceptually made the most sense to me, rather than trying to, guess what the next biotech, discovery is going to be, or what the next technological innovation is going to be. So that was it, and it worked more than it didn't work. Obviously, there's times when it works and then when it doesn't, and it kind of built up this loyal following that we've gotten over the years. And so I'm proud of the long-term relationships that we've built following this discipline. We've got some clients that go back with me now, 30 years, and so that's a long time. And I'm 54, so it gives you a concept of how long I've been doing it for.
Absolutely. And so do you associate yourself more with, let's say, the more, let's say, Buffett moat style of value, or do you associate yourself more with, let's say, the Benjamin Graham cigar butt style of value?
I think that I kind of straddle both a little bit. It's increasingly difficult to find, the kind of Graham and Dodd net situations, but not impossible. And we think we have some, so in the portfolio today. So it's not impossible. It's just harder. And so if you exclusively focus on those, you'll find yourself with a very small portfolio. And so I think that, because it's so hard to find nets and these 50-cent dollars that you can just cash in kind of mentally, I did evolve more into the kind of Buffettonian style of finding businesses that were durable franchises, businesses where there was some kind of a moat, or you could perceive that they were going to be able to produce the cash flows they produced in the past in the future. And so that, I think we do a bit of both. And I think if you look at our portfolio, I think we've owned about 100 names over the last 20 years. You'll see examples of both, where we were buying clearly, net assets at a major discount, some of the parts type situations. And then you'll see other situations where we were buying, a franchise with decades of track record, which happened to be going through a bad time, and where we thought it would be a transitory thing.
Yeah, I think that makes a lot of sense. When you're buying, let's say, an asset that's at a discount to net asset value based on an assets basis rather than an earnings basis, how important is a, let's say, relatively nearer term catalyst that actually catalyzes that value? Because you see a lot of companies, let's take Japan, for example, where they have, they appear that classic sort of Benjamin Graham net, they have quite a lot of cash on their balance sheets, but that cash never seems to really be returned to shareholders. It just sits on the balance sheet. So what are your thoughts on that?
It's so, I had been kind of in my operating mindset had been for a long time that I shouldn't be overly concerned about the catalyst, because the catalyst will come unpredictably when it comes, and I still kind of operate with that assumption in mind, which is that there's this kind of trend in value investing, I think, towards being more event driven, because no one wants to be stuck in a great value that doesn't move, and I get that, and I feel that that's certainly a valid way of going about it. But I do think that some of these kind of left for dead situations have a way of coming back to life unexpectedly. And Japan is kind of a good example of that. For decades it was a widowmaker for value investors. I mean, it killed so many people, high profile people, that just kind of got stuck in that quagmire of things that don't move unless you really force it, and you couldn't force it because Japan had such strong barriers to any kind of activism. But now you're seeing real change, and so we are finding values over there, and increasingly interested and focused. So I would expect that you would see in our portfolio more Japanese names in the future, and I think Japan is changing. I think Japan is one of the biggest, I think, changes that's upon us right now in global value investing, is that Japan is working, and it's becoming, workable, and where you can get things done there. Activism, things that are happening in Japan right now have never happened before, in terms of look what's happened with Toshiba, look what's happening in some of the smaller situations. So I think Japan has got the potential to be kind of like the US was in the late 70s, early 80s, in terms of, getting inefficient capital structures made efficient. And I'm not just talking about leveraged buyouts. I'm talking about getting excess cash out to shareholders, buying back stock, things like that, special dividends. It just seems like it's not only ripe for it, but it's actually happening. And so I really do think that Japan will be looked back upon as having reached some kind of a turning point recently. And luckily we found some good people to partner with in Japan that have got boots on the ground there, because you really do have to kind of have that to operate in Japan. It's one of these markets that is very difficult to maneuver in unless you really do have either boots on the ground or a partner with someone. So we have made some good contacts over there, made some friends with the people at Dalton, for example, Dalton Capital. Jamie Rosenwald has been hugely helpful in our research in Japan and our efforts there. So yeah, I think that Japan's a place to look and to go, but to do so with experienced partners that have got boots on the ground.
Is there a specific type of business that particularly appeals to you in Japan? So, for example, are you more attracted to, let's say, the conglomerates there, or to, let's say, businesses that are smaller businesses and might really have, let's say, a very high market share in more of a niche? Are you interested, let's say, in businesses that appear maybe cheaper on an asset basis, or ones that appear cheaper on an earnings basis? What are your sort of thoughts for which types of opportunities you look for there?
Yeah, I think it's always a mixture. The opportunity, there's some very unique opportunities in Japan that fit either all of those characteristics at once, or one of them so dramatically that you feel compelled. So there's such a pervasiveness of. I mean, the numbers are incredible. The number of you could literally throw darts, but you don't want to do that, because why should you? You've got this amazing menu of opportunities. Why not try to refine it to something that's really ideal? So I think that what we're doing there is trying to hold out for situations where we have heavy insider ownership. So we have somebody that we actually like involved, that's shown a real care and skin in the game. We just maybe need some prodding in order to get to that next level. And in the absence of that, the kind of cheapness that is just jaw dropping, where you're looking at net cash balance sheets and you're essentially getting the business for free, that kind of a thing, and that's still there, or you're paying 3.5 times EBITDA for a business that should trade 7 to 10 times over and over again, and it's net cash balance sheet over and over again with securities, unnecessary investment portfolios that have nothing to do with the business sitting there, or unnecessary real estate or other assets. So it's just a really interesting place to fish around, and I think that the smaller and mid cap size opportunities for smaller firms like us are particularly appealing because we actually could have a voice in those places and actually be effective. Whereas in order to get a Toshiba to do something, you need to be a massive firm like a KKR or something like that.
Yeah, I think that makes a lot of sense. And how do you feel? I mean, there's some countries in particular in East Asia and also some in Europe where there tends to be, I think, a higher prevalence of family-owned businesses where they've been passed down generation after generation. Have you invested in like family-owned businesses in the past? And what are your feelings on those typically compared to non-family-owned businesses?
Yeah, I think there's good and bad, and it depends on the history, the treatment. Do they treat shareholders like family? Do they treat the outsiders like partners, or just the family itself? Continually, try to avail itself of opportunities that the shareholders don't get. So there's different approaches, different types of families. We try to invest in the families that we think are going to behave well, and that we think that we've discerned a track record. Or if that's not in evidence, then we will demand other things, where we'll evaluation that we think where we can't lose, something like that. But yeah, I mean, I think the family ownership that you see in some of these Asian firms is net a good thing usually, because it does show that there's a dedication there, and that skin in the game is usually a motivating factor that allows these firms to survive in very volatile times. So when you look at the history of Asian securities markets, there have been some extremes, and these firms have made it through that because I think of the discipline that having all of your net worth in a particular security brings. So I do think that the skin in the game aspect of it is probably more important than the sometimes I think there's a tendency for some of these family-owned firms to maybe engage in nepotism or do side deals with interested parties that may not be in the best interest of the company, or even maybe do something against minority shareholders that are in favor of the family. So that does happen, and we have on occasion made mistakes in engaging with a family-owned company or family-controlled company where we thought that they would behave nicely and they didn't. So it has happened on occasion, and so we don't always get it right.
Yeah, absolutely. And transitioning to a pretty famous past investments of yours, Carmike Cinemas, can you talk about how that investment ended up playing out? And also, I mean, people were very, very pessimistic on movie theaters, especially during, I would say, the peak days of COVID. Did they ever get to that point where movie theaters were so cheap that you thought some of these opportunities became attractive in the space?
Sure. So Carmike was an interesting situation. Based in Georgia. I'd been aware of it for years. I had actually bought their bonds during a bankruptcy. So they were in bankruptcy in, I think, 2000, 2001. And I bought their bonds, I think, around 27 cents on the dollar. They went down to 17 cents on the dollar, ultimately sold it at 70 cents on the dollar, and went to par. And bankruptcy actually was one of those rare bankruptcies where the equity survives. And so I didn't own the equity back then, which is regrettable because it went up a lot. But I did get involved in it years later, and it ended up being initially a difficult position. I bought it on the concept that it was somewhat of a turnaround, where they had a nice franchise primarily in the southeastern part of the country, but they were the fourth largest movie theater chain in the United States, and it had just been run down by prior ownership. The private equity firm and the family that controlled it before were really kind of milking it for cash and not doing the necessary renovations and just not taking care of it, the upkeep that was necessary. So we felt with new management, when that came in, there was a chance. It just took a long time. I think it took 4 years or so before we started to see the changes that management was bringing in terms of cleaning up the theaters, retraining management, actually starting to bear fruit in terms of attendance coming in better than expected. So it was a trying initial 3 or 4 years. Ultimately, it turned out to be a very successful position. We exited after, I think, an 8 or 9 year holding period with a very satisfying gain. It was ultimately sold to AMC and AMC became a new position for us that unfortunately did not work out initially. AMC initially, after we converted some of our Carmike stock to AMC stock, AMC tanked. We ended up buying more. I think we made a small gain in AMC in the early part of last year after it took off on the kind of meme stock thing. So we were able to exit that position with a small gain as a result of that, which is luck more than skill. But we have been involved in another theater chain, and we're still involved in another theater chain, which we got involved in during the COVID crisis, which is Cineplex. So Cineplex trades in Canada on the Toronto Stock Exchange, and it's the dominant theater chain by far in Canada. It's got like 75% market share in Canada. No one comes close, and it's very well run. So this is a exquisitely managed business by a guy named Ellis Jacob. He's been there for 20 plus years. We bought the stock, I think, very cheaply. It's roughly doubled from our cost. I think it's worth roughly double again what it's trading for right now in the open market. So I think that Cineplex is worth a lot more. Will probably get to be worth, what we think is worth as the business starts to recover. So the theater business is starting to come back. It's been a lot slower than we expected because COVID has lasted longer than we expected. So I was thinking when we bought this thing that, the whole crisis would be over and done within a year because, the Spanish flu lasted about a year and a half. This has now been 2 years. And so that completely blew up my initial expectations on how quickly theater stocks would come back. And Cineplex has suffered as well. But I do think it is coming back. I think one thing that's been proven is that people do want to go to the theaters again. You can see it when there's a decent movie, people come. And so we're seeing really good numbers when the content is there. And so I think the proof of concept is there. And so Cineplex is an ongoing exposure we have to the theater space. And I think it will, continue to be successful for us.
Yeah, absolutely. I think that makes a lot of sense. And can you speak about your thesis for AMA Group as well, please?
So yeah. So AMA is of a reopening play. We're investing on the belief that the business will revert to the mean at some point as the business reopens, and this also has taken longer than expected. So I think we're a year into this investment, and it's well below our cost. And part of that is due to the fact that this COVID crisis has lasted a full year longer than we thought, and the business is only now starting to recover. So what is the business? The business is repairing cars. They are a collision repair company in Australia. They have a uniquely dominant position there. So as a result of prior acquisitions, I think the business has about 15% of the market in Australia. I think it's a $6 or $7 billion a year business industry wide, and they have, on a normalized basis, roughly $900 to $1 billion of sales out of that. So that's a very big concentration to have. When you look at the companies in North America that do this business, like Boyd's in Canada, which has done it very well, it's kind of the gold standard. They're nowhere near that big relative to the industry. The offset to this is that AMA is selling their services to a much more concentrated customer group. So it's the benefits of scale that they have are somewhat offset by the fact that the customer base is also more consolidated and more concentrated. So their biggest customer is like 40% of their business. That's a customer concentration level that's much higher than what you see with Boyd's, where I think they top out at around 11% or something like that. So there's a balance there in terms of balance of power. And some might argue that the insurers have the upper hand, which limits AMA's ability to get pricing when they need it, and that remains to be seen. So right now we're going through this period where they've got to get better pricing from their insurance customers as a result of the increase in cost that they've endured from not just labor but from parts. As everyone knows, the supply chain disruption that has been caused by COVID has led to an increase in costs across the board, not just in the parts themselves but in the shipping costs. So they've had to eat a lot of that because of the contractual nature of their pricing. And that's led to some pretty horrific numbers over the last year or so. But we do think that they will start to get and have begun to get better pricing from their insurance customers, and that should lead to, we think, normal margins. So I'm expecting, I think they're anticipating getting to something north of 8% EBITDA margins at some point. And in EBITDA, the EBITDA measure that we're talking about is pre, this new lease accounting standard. So I always try to go back to the old way of thinking about EBITDA without the lease expense, because I just feel that it's too complicated to do it the new way. And so based on the old numbers, a normal EBITDA margin for me would be somewhere in the 9 to 10% range. They are anticipating getting back to 8+. I think they'll actually get back to 9 to 10%. I think that's where if we have a different point of view there, that's where we differ. The analyst community is very pessimistic about the pace at which the industry will recover and the margins that they'll be able to attain, upon that recovery. And so we have a different point of view there. And I think that's what makes the opportunity so attractive, because the consensus is really pessimistic on it.
Yeah, I think that makes a lot of sense. And we already spoke a little bit about investing in Japan. And what are your thoughts about investing in China or Hong Kong and some of the political risks there?
Yeah, I mean, it's clear that in a kind of in the Chinese economy, where the government can play a very big factor in pushing things at the margin, you do have this risk that can pop up from time to time and can hurt you. We've seen that in some of our Chinese or Hong Kong listed holdings. We have a very sizable position in a company called Greatview Aseptic, which is listed in Hong Kong, but it trades. Its business is primarily a Chinese business, so their operations are primarily in mainland China. They sell aseptic packages, which are like juice boxes. When you go to the 7-Eleven, if you were buying apple juice for a kid, you would stick the straw in the top. That's a septic pack. In China, the major end use is for milk. So they have this UHT milk, which is ultra hot treatment milk. It essentially is milk that can be stored at room temperature for, I think, 6 months to a year in these aseptic packages, which allows it to be made available to on a distribution basis where there's no cold storage. I mean, there is some cold storage obviously in China, but it's not nearly as pervasive as it is in the West. And so this is a more kind of ESG friendly way of going about getting liquids to a population, milk, juice, things like that, because you're saving money on the refrigeration cost. You're saving money generally on shipping costs, because these types of packages are shippable in a form factor that is more efficient, and you don't have the excess cost of some of the the waste. These are highly recyclable units, so they're made of materials that are almost all recyclable. I think it's liquid paperboard, aluminum, and polyurethane. So essentially, almost the entire thing is recyclable, and it's. So I think it's one of those things that we're doing. I mean, we're not trying to, put ourselves out there as a green investment firm, but it's one of those things that I think we can be somewhat proud of in that we do have this investment in a business that is, making the world a better place and making money at the same time. And this is an example where the controlling shareholder, who owns, I think, just over 10%, has been around since the inception of the business. So, more than 20 years now, and has never sold a share, as far as I know. I think I've looked back since the stock IPO'd in 2005, and I don't see him as having ever sold a share, which we like. They do pay out almost all of their free cash flow as dividends. So one of the ways that we get around the worry about kind of getting, being the sucker at the poker table in China is that, we look for firms that do have a history of paying out their free cash flow as dividends, so that we know that it's not another Sino-Forest, that we know it's a real thing. And so they have paid out almost all their free cash flow over the years as dividends, which has made the total return on the investment actually pretty nice. The stock price hasn't done so much, and it's actually been particularly weak lately because the cost inputs have been screaming higher, and they have not hedged because they're a relatively small firm. They felt that hedging would be a bit too expensive for them. I actually disagree on that front, and I hope they'll change their ways there. But the lack of hedging on the commodity input costs really messed up their last 12 months, and will probably continue throughout this year. But I think that they will ultimately get pass-through pricing. I think they renegotiate on an annual basis with their end customers. So the major milk companies in China, they will get the price increases I think they need to retain their their margins, generally speaking, have run around 15 to 18% EBITDA margins, and I think they'll get back to that level in the not too distant future. And the business itself is actually a secular growth business, so it's not like this is a stagnant business. This is aseptic packaging. When you look at all the various types of packaging businesses you might invest in, it's actually grown at an above average rate over the years because it is finding favor amongst especially the emerging markets as an eco-friendly alternative to getting to these emerging middle class consumers. So we really like Greatview Aseptic, and there may be a catalyst here. You asked about catalysts. We don't demand it normally, but just recently, the largest shareholder, Jardine Strategic, which is part of the Jardine Matheson Group, they own 28% of the company. They bought their 28% in a couple of block trades at around $5 Hong Kong per share. And this would be 4 or 5 years ago, maybe longer. And it hasn't done well for them since then. And there was a story out recently, a month or two ago, that they've hired JP Morgan and they're looking to potentially sell that stake or do something with it, strategic alternatives, that kind of thing. But, with the stock at 3.25 right now, I think it's worth easily double that. And so there may be, a reason to hope that the transaction may result as a result of this kind of considering strategic alternatives by the largest shareholder. So that's an example of value with a potential catalyst where we happen to be, I think, the number 3 shareholder. I think we own about 6% of the stock.
Yeah, absolutely. I think that makes a lot of sense. Can you speak about your investment case for Revlon as well, please?
Sure. Well, Revlon's been a kind of a problem child for us for a while now. We started investing in it in December of 2010. We paid $10 a share. For the next 4 years, it was great. It went up to 40, and we sold, I think, around 20% of the position around the $40 range. So it looked like a great thing. But over the last 6 years or more, it's been down, and it's been stuck around this level, around the $10 level for a long time. My expectations with Revlon have been thwarted repeatedly by either self-inflicted wounds that Revlon has caused by they switched over to SAP software a couple of years ago during what I thought was a very potentially risky time for them to do so. And you've heard all these horror stories about how SAP transition or any type of new implementation on that scale with the enterprise software can be sometimes disruptive. So why do it during a period where you're already kind of in a weak spot and you have a highly leveraged balance sheet? And that really hurt them, 5-6% of sales one year. Then we had this transition to newer brands, internet celebrity brands. Now, that's something they could have been a little bit more in front of. So, a self-inflicted wound in that they were late to embracing Instagram and, using these newer modalities to get to their customer. And so that was a self-inflicted wound. But then COVID happened, and that was completely out of their control, but they survived it. They survived it barely because they had a highly leveraged balance sheet getting in. We were confident that the controlling shareholder, given that he had so much skin in the game, would aid the firm if necessary, because he's got pretty deep pockets, Ron Perlman, maybe less deep than they used to be, but I think deep enough to keep Revlon going. And that was the case. He actually did, I think, put up a little bit of money to get them through that tough time. So they're through the storm. We see EBITDA margins, gross margins starting to come back towards what we think is normal. That business, we think, should have normal margins somewhere. And gross margin should be somewhere between 60-65%. EBITDA margin should be somewhere between 15 and 20%. And we think they're headed in that direction. And if it gets back there, we think the stock is worth $27 easily, which is obviously nearly triple the current price of roughly 10. So and there's also maybe a potential catalyst there in that Ron Perlman was rumored to be in some kind of a liquidation mode due to potentially financial duress. I have no idea if that's true or not, but what I do know is he has been selling a lot, selling homes, selling art, selling. He sold a big stake in Scientific Games. So Revlon would be the last major public holding that I'm aware of that he's owned, and he's owned it since 1985. So he may be thinking about it. And we know that he did hire Goldman Sachs 2 or 3 years ago to consider strategic alternatives, and so Goldman Sachs, that process has not been officially ended, as far as I know. So I think that's an ongoing process, and so there could be a transaction there. Either part of the company could be sold. They own Elizabeth Arden, which is a very nice, discrete asset that serves more high-end customers, more in the prestige aspects, but very popular overseas, and growing nicely. And they own some other smaller brands like American Crew. You'd be surprised, but American Crew, which you could find at a drugstore, this hair gel, hair pump, I think they're number one in the country. And so that's a nice little business that's probably worth 300 million or more.
Yeah, absolutely. That makes a lot of sense. And do either quantitative or keyword screeners play a role in your investment research?
I haven't done keyword screening. I'm nothing against it, but I just haven't done it. And we don't do quantitative screening per se. I mean, clearly there's a huge quantitative aspect to everything that we do, but we're not doing like a quantitative filter, for example, to try to find our universe that way. And the only reason for that is that I've never found myself at a loss for potential ideas. I mean, I've got lists and lists, screens and screens of ideas that I'm constantly torturing myself with. Is it the right time? Is this the thing to do at this moment? And so many of the things that we do have been on my kind of to-do list for years, and it wasn't until a certain moment happened, a certain crisis happened, that got me involved. And so I think that rather than allow computer screens to lead me in a certain direction, I've kind of led myself by reading and updating my kind of broad universe of potential targets, and doing that more proactively. Another reason for not relying on screens is that I've noticed, particularly with the foreign names and particularly with Japan, that screens will give you, will not notice a lot of these things. For some reason, Japan, a lot of the stuff doesn't make it on a Bloomberg or a Capital, IQ, what do they call that? Anyway, you know what I'm talking about. The various screening services, informational services, Capital IQ. They don't necessarily show some of the balance sheet assets that they should show, and I don't know why that is. It doesn't come through on Bloomberg. It doesn't translate. So you might miss a huge chunk of the enterprise value in a liquid security that just is not showing up properly there. And so I have found that in many of the best things that I've done, if I had waited for a screen to spit it out, it would never have come across my plate. So that's why I think we haven't done that. But nothing against it, and maybe by adding that, maybe we could be better. But I found myself kind of overwhelmed with the opportunities that I'm looking at already.
Yeah, thank you for that commentary. It's very intriguing. And can you speak a little bit, please, about how you analyze management?
Sure. I mean, I think management is best analyzed by what they've said and done over their careers. And the only way you can really get a sense of that is by reading everything they've said and done over their years. So it's a very laborious process if you can do it. I mean, sometimes there is not a huge historical record to go by, and in that case, you're going to have to make some determinations that are going to be more intuitive maybe than really just fact based. But I do think that that's a critical thing to do. So what I do is read, if it's available, the conference call transcripts going back, almost as long as I can find, and try to make the time to do that. And the annual reports, particularly the annual letters. What I found is that there is a certain type of CEO that you will get to know in your investment career, and you start to see that this pattern of behavior, this pattern of communication, where you just know that this is the kind of guy you want to be aligned with. I think there's a book, I know there's a book called The Outsiders, which talks about, extraordinary CEOs and how they go about capital allocation and what makes them so unique. And so that's a classic, but there's many other books, many other examples of these types of guys who really take it upon themselves to do the right thing, and to go above and beyond, and treat shareholders fairly, like partners. These Warren Buffett type characters who are not greedy, who are, they're greedy for profit, they're greedy for their shareholders, but they're not overreaching, and you just, there's a straightforwardness in the way they communicate in the annual letter and on the conference calls, and you will see it. And it doesn't have to be a guy from the Midwestern United States. It could be a guy in Asia. It could be a guy in Europe. You will see this and you'll get to know it. And I think that's the most kind of valuable bit of pattern recognition that we do in this business, because getting to know who to trust and who not to trust, who do you want to be aligned with? What's the kind of guy? And if that's not there, and if you get involved in a situation where that's clearly not there, you can still make money. And we do that very often. So don't get me wrong. We're not exclusively investing with good management. We want to have every facet covered. So we'd like to have good management, good business, good valuation, or great management, great business, great valuation, all those things. But they rarely are always there altogether. So sometimes we will get involved when we know we don't have good management, when we think we actually have atrocious management, and where the opportunity is that can change. And so sometimes, very often actually, I think that is the case, where we're getting involved in a situation where we know it's been mismanaged, or we know it's been less than ideally managed, but we expect that to change. If not by someone else doing it, then maybe we ourselves would get involved. And we have done that on occasion. I mean, we're not activist investors by trade. It's not something that we hold ourselves out as being, but we have done it in self-defense, I think, on occasion, and mostly with success.
Yeah, absolutely. I think that makes a lot of sense. And can you please discuss your thesis for international game technology?
Sure. So IGT is one of the biggest lottery systems operators in the world. I think they have somewhere in the order of 75% of the market in the US, maybe more. So if you were to buy a lottery ticket, which obviously is not good investment advice, I wouldn't suggest that, but if you were to buy one in New York, IGT is the company that is providing that service. So they will get a small percentage, but a meaningful percentage of every transaction that goes through those machines. And they will update those machines every 5 or 10 years as the contract requires. And they usually have very high renewal rates, something like 90% of renewal rates on these customers. So that is a high margin, highly recurring free cash flow generating business that we really like. There are sporadic cash outlays that will interrupt these free cash flows from time to time. For example, they have a huge Italian business where they have to, every 10 years or so, pay up to renew the contract. And so you have to, when you're trying to figure out what the free cash flows really are for a company like IGT, you have to look at it over a 10-year period and try to see, because there will be these sporadic increases in CapEx or renewal payments. So you want to smooth those out and get a sense of what it is. Otherwise, you might be over a big year in free cash flow. Doesn't necessarily follow a big year. It can be, there's some ups and downs, but we do think the business is capable of generating, somewhere around 500 million a year of free cash flow. Stock, trading down, actually, it was down 15%, I think, today on earnings that were maybe slightly less than what consensus was expecting, but nothing that changes the thesis in my mind. So I still think it's worth in the upper 30s, somewhere closer to $40 a share. We've got a good cost basis here. I think our cost basis is around 15 or less, something like that. But we like the free cash flow. We like the heavy insider ownership. The family that controls this, the Italian private equity firm, it's really a family-controlled firm, has been involved since 2002. So they're long-term owners. It's the biggest thing that they're involved in terms of their net worth. And you have seen a decent amount of transactions in this space recently, and transactions that are happening increasingly attractive multiples. So I think because of sports betting, even though sports betting is a relatively small amount of IGT's business, it is growing quickly, and they do provide the systems for a large number of sports betting operations in the United States, where it's obviously growing very fast. And so I think as that becomes a more meaningful part of it, maybe IGT's multiple gets a little bit of a boost. But I really think that it's just fundamentally undervalued because people have not, I think what had limited the valuation had been their weakness in slot machines. So they really dropped the ball with slot machines for a number of years. They were losing market share. They had lost some very talented people that they shouldn't have allowed to leave. But they're getting back. So we think their market share has stabilized in slot machines. Slot machines are, a much smaller portion of the business today than they used to be. Lotteries have become really dominant. I think it's like 70% or so of their free cash flow or EBITDA comes from lotteries now. And lotteries are a business that I think should command a higher multiple than the slot machine business, because they're less cyclical, and they really did perform very well. You would think that lotteries would have collapsed during COVID, but some of these people, these hardcore people, they went out and they got their lottery tickets no matter what. So and lotteries are changing in that they should be more accessible to people, in that more and more states are allowing lotteries to go online. So you could, I think, I don't think New York State is there yet, but I think that increasingly you're going to be able to buy a lottery ticket on your iPhone. And so, think about it. I mean, I think most people that you and I know would probably not motivate to go to the store to buy a lottery ticket, but if you could do it on your phone, and you see some huge number, maybe that, I think it'll be incremental demand. And so I think that that's something that we can look forward to, because that's just starting to unroll now. And state by state, I think they're finding ways to go about that, with the controls against abuse, because I think the concern has been that giving people access to gambling too easily on their smartphone might lead to abuses, but there are controls and software controls that are put in place. So I think there's going to be a decent tailwind for growth in that business, and I do think that there's probably an exit strategy for the controlling shareholder at some point, because they own 50% of the stock. They've owned it now for 20 years. They're getting on in age. The controlling families, the guys that run it are late 70s, early 80s. So I wouldn't be surprised if we see a transaction there, at a price that I think would be north of what I'm estimating for fair value.
Yeah, absolutely. And can you speak a little bit about your thoughts about how important is an MBA or a CFA in the investment management industry, particularly in regards to value investing?
Yeah, I mean, I don't have a strong opinion about it. I don't have a CFA. I don't have an MBA. I consider myself fairly well versed in the esoteria of the business, and that didn't come about overnight. I actually had to proactively go about educating myself. So when I started out, I was a stockbroker in 1990 at Shearson Lehman Hutton. There was a McGraw-Hill building not far from me, and it had a bookstore underneath it. And I went there and I bought books about accounting, about economics, about I learned about the various things that one might learn in a business school if one was focused on that. So I was a psychology major in school. I was not thinking about being in this business at the onset, so I really had to catch up, I thought. And I subscribed to various magazines, Institutional Investor, a CFO magazine, which I don't think exists in print form anymore. I read whatever I could read that would give me the back knowledge to be able to read balance sheets, income statements, to get to know the business from that perspective. And I think that having a CFA or an MBA, to the extent that it gives one more knowledge, is great. But I don't think it's a prerequisite for being a good investment manager. I think a lot of the guys that I've grown to know and respect don't have that, have either one of those. It doesn't mean that I would be in any way looking at someone with that in a negative light. But I'm just saying that a lot of people are self-taught, and being self-taught is fine, because if you're diligent about it. I mean, there's a lot of guys that have CFAs and MBAs that are utterly worthless. So it's all about how much effort are you putting in, how much focus are you putting in. I would gladly take a guy that's self-taught over a Harvard or Wharton MBA or CFA if that guy has shown me that he's willing to do the work, and willing to really dig and to have, to think what others haven't thought, to question yourself, question your presumptions, to look at both sides, to be dispassionate, because really more than intellect, more than what school you went to, more than what your labels are after your name, it's about the temperament. And if you have the right temperament, I mean, Buffett's talked about this extensively. I think temperament does trump those things time and time again, because the smartest guys will curl up in the fetal position sometimes, and it happens over and over again. I mean, look at what happened during the COVID crash. There was a lot of guys with a lot of money who were frozen. and did not do what they should have done. And same thing with 08, 09. I mean, there were companies there that you would have thought would have gotten scooped up by somebody that had a lot of money, but they were frozen. And part of that freezing process is that the private equity firms, which are sitting on cash, don't have access to the leveraging capacity they normally would because the banks don't give it to them. But still, you could have bought things for all cash and made a fortune during these periods, and it wasn't done. And I think it wasn't done because of fear and temperament. So I think that if you have that discipline to be, even if it's not in your nature to be so kind of dispassionate temperamentally, if you can train yourself to be that way, which I think is possible, then that's maybe more important than any of those labels.
Yeah, absolutely. And are there any industries that you tend to avoid because they don't really fit in with either your circle of competence or your value investing philosophy?
Traditionally, I think I've avoided what a lot of value guys have said they've avoided, like airlines, automobile manufacturers, really super cyclicals that don't seem to generate great returns over a complete business cycle. So when you look at it, I talked about IGT averaging out the years that have high capex versus the lower capex years to get a true sense of free cash flow. If you do that with airlines or with automobile manufacturers, generally speaking, what you'll see is that the periods during which they're burning cash, almost completely offset the periods in which they're making money. That's a bit of an exaggeration, but it really does have a kind of a damaging effect on what the total return is over a long period of time. And so I've been averse to those businesses, generally speaking. Doesn't mean I would never buy one. I mean, I think there are special situations. We just bought recently. You wouldn't be aware of this because I actually haven't spoken about this yet to anyone. So I guess you're going to have the first look there. But we just bought a bus manufacturer. So that's a heavy manufacturer, cyclical, but it's more of an oligopolistic business where they're competing with only a handful of firms globally, and where they're one of the biggest, if not the biggest, in the business. It's a company called NFI Group, which trades in Canada. Very well run company, outstanding management, high insider ownership, excellent free cash flow generation over complete business cycles, and where the business is just starting to come back now from the COVID problems, and where municipalities are actually really kind of almost in a position of being supercharged for upgrading their bus fleets, because everybody has got this stimulus money in trying to go green. So a lot of the municipal, New York City, for example, MTA is putting a lot of electric or gas-fired buses in the streets, and this is a way of making everything cleaner. And NFI is one of the biggest producers in that regard. So it's you want to play electrification, you can buy Tesla, right? I wouldn't do that because to me that valuation is very hard to grasp. But here we're paying a discernibly low valuation for a business that should grow better than the average car manufacturer, with better than average free cash flow generation, and we've got a proven management team at the helm, and where they've been really good capital allocators over time, and excellent about sharing their free cash flow with us as dividends, because they themselves are large shareholders. So yeah, NFI, we just bought it around, just literally in the last few days, we bought it around 18, 19 Canadian, and we think it's worth roughly 35 or so, which is a good deal more than it's currently trading for.
Yeah, that makes sense. And can you please share your investment thesis for Viatris as well?
Okay, yeah, Viatris had a terrible couple of days. Viatris is a combination of Mylan Labs, which is a generic firm that most people are familiar with, that had some troubles, was not ideally managed, and Mylan competes against the likes of a Teva from Israel in the generic space, and a merger with what was the old Upjohn pharmaceutical business, and so those two businesses together, you might not think there would be natural synergies there, and maybe there aren't a huge number, but there are enough where putting them together seemed to make sense. We bought it after it had been put together and kind of sold off because people didn't want, there wasn't I think that it came out of Pfizer. There wasn't a natural buyers group here because it's not just generics and it's not just branded products. So I think it kind of got sold off like a lot of spinoffs do, and it has been somewhat disappointing in terms of them not making their projections. Once a year, it seems like they're kind of downgrading expectations, and they just did so again, and that was really, I think, what disappointed Wall Street. But it doesn't disappoint us to the extent that, I mean, the stock they lowered their sales estimate by, I think, maybe 3 or 4% for next year versus what the consensus was. The stock dropped 30% plus in 2 days on that news, and it was already very cheap. So what you're dealing with in now, I think our average cost here is around 14 or so, 14 and change. The stock is 10. At 10, you're looking at a free cash flow yield of 20%, meaning it's trading at about 5 times its $2.5 billion worth of free cash flow. And that's, even if it doesn't grow at all, imagine if you could buy the whole thing at that price. And I told you, you can buy it at this price and it will not grow for 10 years. Well, I'm making 20% a year for 10 years. That's not too bad. So for some reason, the analyst community doesn't see it that way. And unless it's growing at a reasonable rate, they've decided that it's not worth it, almost anything. But for me, 20% free cash flow yield on a business that should be at least stable if it doesn't grow very much is appealing. And I think there's some reasonable shareholders involved that might pressure for some kind of a corporate action if it doesn't seem like they're going in the right direction. Compensation is a little bit higher than it should be in our estimation. I think that's a problem. There's a history of that with the Mittleman side of the business. I was hoping that might be curtailed a bit more given the merger, but it seems like they're a bit top heavy in compensation, I think. And that's a factor that I think that institutional investors can speak up about and maybe influence. But generally speaking, it's a stable business. It's high margin, relatively speaking, very predictable. It disappoints sometimes, but I don't think the disappointment is nearly worth the reaction that we just saw. So yeah, I would say with Beatrice, it's a very opportune time to look at it. And we actually may increase our position. I mean, we have a 2.5% weighting in it at 14.5. I think we may, buy some more down. So it's not a definite, but it wouldn't surprise me if we did that.
Yeah, absolutely. I think that makes a lot of sense. Can you speak about, let's say, 2 companies that you owned in the past and sold out of, one which was a very successful investment and one which was not so successful investment, as sort of case studies for us?
Oh, that's a good idea. Let's see, something that we sold out of that was successful and something that wasn't. Let's see here. Well, I guess, trying to think, what's something that we exited completely recently, because we haven't had, a lot of turnover lately. We've been kind of, holding, our positions for a while. But I would say that, well, I guess let's start with something that didn't work out, because I have unfortunately a few more of those at the top of mind than I do otherwise. So I mentioned a company recently that was a big shareholder in Great View Aseptic. Great View Aseptic's largest shareholder is Jardine Strategic. We used to own Jardine Strategic as a kind of sum of the parts play on what we thought was a very high quality collection of assets. And we bought it with the idea that we were getting, I think we paid, our average cost was probably around $30 a share in US dollar terms. It was a company that only traded in Singapore, a very large company, multi-billion-dollar firm. And it had been around forever. Jardine Matheson has been around for hundreds of years and owns a very high quality assets throughout Southeast Asia. And the family, the Keswick family that controls it, we thought, would treat minority shareholders well, because they had traditionally been, fairly, fair dealers. We ended up selling the stock for essentially break even after, a good bit of time. And we owned it for a few years. So it was, a frustrating opportunity cost to have been in the stock for a number of years and sell it for roughly break even, around $30 a share. But it turned out that we sold it just before the market collapse of COVID-19. So it wasn't that we foresaw that. I had been hearing inklings about the virus and whatnot. I think we sold it in January or February of that year before it became really understood as to what was about to happen. But the reason that we sold it was because of troubles in Hong Kong. So they have a big part of their NAV was a big stake they have in Hong Kong land, which is a REIT-like business in Singapore, which owns a big, very important commercial real estate in Hong Kong, and it's a huge chunk of their NAV. And I did see the potential for problems in Hong Kong kind of metastasizing, and that's what happened. So we ended up selling it on that concern. The stock ended up falling during COVID to less than 20, I think. Ended up, I think that Jardine Matheson bought the stock, bought the company back, minority shareholders out at a price that was that I thought very unfair. I think not much. I think it was even less than what we sold it for. I can't remember exactly what the number was. So my thesis was proved wrong, which was that the sum of the parts that I thought would be available for us to realize would not have been, even if we stuck with it, because the Keswick family ended up buying out shareholders, not by exchanging stock from Jardine Matheson for Jardine Strategic, which I thought would have been the fair way to do it, but by buying them out for cash during a bad time and kind of taking advantage of that. And so that was an example where the thesis was wrong. We got out relatively unscathed, but the thesis was clearly wrong, and something that I hopefully will learn from in terms of my qualitative assessments about the people at the helm. Let's see, an exit that actually worked out nicely recently. Well, I guess we did exit, some of our Cineplex holding. We sold about half of our Cineplex into the strength last year. So in the throes of the darkest part of COVID, we ended up buying the position, and then it more than doubled last year. At one point we sold about half of the position, so it went from a 10% weighting to a 20% weighting. On that move, we sold half the position, and we retained the other half to this day, with the expectation that it will hopefully double again from here. And so Cineplex was an example of just being ready, because we knew the business. Waiting. I had wanted to own Cineplex for probably 20 years. So Cineplex was always my kind of number one ambition in the North American theater space, but it had always been too expensive because it was recognized as being so high quality. So I was never able to get it at a price that I thought was cheap, because for so long the market valued it very highly. And then COVID came around, and suddenly there was no safe place for anybody, and even the highest quality businesses were marked down to next to nothing. So I think in that circumstance, that was a success born of discipline. But not every success is a complete success either, because you can feel failure sometimes in success. So we owned Avis Budget Group during the crisis. So we bought Avis Budget Group as low as, I think, $10 a share, something like that, during the crisis, thinking that I had been aware through prior exposures to Avis Budget Group that the business was cash generative during bad times, because they could liquidate fleet very quickly. So in a matter of weeks, they could right size their fleet to the point where and draw working capital out to get them through the hard times. So I was very confident that would be the case. It was the case. We ended up buying the stock somewhere 10, 15, selling it around 40, which was a big win, right? 10, 15 to 40, big win. The stock went to hundreds of dollars a share after that on this kind of well, first of all, they were over earning because used car prices went up, and they are also, they're renting cars, but they're also in the used car business because they're selling used cars, and they went to unprecedented levels there. So there's an example of where a success doesn't necessarily feel like a success, because you sold something at 40 that went to $200 or $300 a share not long thereafter, and so I guess it's all relative.
Yeah, absolutely. That makes a lot of sense. The next question is, how do you look at diversification and position sizing in a portfolio?
Yeah, I think we don't have any hard, rigid rules there. I don't think we've ever gone beyond, a 30 or 40% weighting in anything, even for, sometimes things appreciate quickly, and you might see that happen, but we're pretty cognizant about getting those things down to more normal levels. So I would say that generally speaking, we would probably top out around a 20% weighting in something. More likely, 5% would be what we consider normal. So you'll see in the portfolio, there's never anything less than a 2.5% weighting, because I do want to make sure that if we're getting involved with something, that it's going to be at least my conviction level will be such that I feel a 2.5% weighting, can be, should be done, because that's meaningful. I mean, 2.5% is meaningful, and I don't want to be tiptoeing into something and giving myself the flexibility to kind of, have a number of tiny little stakes just to feel some kind of psychological satisfaction, have exposure when it's meaningless exposure. So I want to have a meaningful stake in the portfolio in anything that we do, but not so much that we bet the whole firm on one idea.
Yeah, I think that makes a lot of sense. And then for a concluding question, what are the most influential events of your investing career?
Well, I would say the most influential, or the most important events that I guess I've lived through as an investor would be the Asian financial crisis that started in 1997 and ended in 1998, where it started with the Thai baht coming undone, and then the Russian ruble coming undone, and Russia defaulting. That was a really interesting, eye-opening period that taught me a lot, and we actually did well during that period for the clients that the foundation of Mittleman Brothers were the clients that I had back then. I would say the internet bubble was also a huge thing for us, because in the year 2000, going into 2000, we had been wrong for a very long time about the valuations of these internet stocks. They kept going up. We owned a fully invested portfolio of value stocks. Over the next 3 years, the market collapsed, and we made, I think, about a 20% return over those 3 years, which was not out of line with other value investors, but it was a very important kind of foundational credibility boost to the strategy that led to a lot of our investors coming to us. And then I would say the financial crisis of 08, 09, another period where we had a lot of pain in the short term, but ultimately we were rewarded. So if you judged us based on 08, you would think, wow, these guys really are terrible. They were down 64%. But over a 5-year period from the end of 07 to the end of 2012, we made 100% return while the market was just getting back to break even. So I think we kind of proved our way of value investing as being valid during those periods. And so those were probably the most important periods that we've gone through thus far.
Yeah, absolutely. That makes a lot of sense. Thank you so much. This is a really terrific session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
Yeah, thank you for having me. I really appreciate it. Thanks for the questions.
Great. Have a great day. Thank you.
You too. Bye-bye.